Next guest says that this week's FOMC meeting is going to be viewed as dovish. I want to bring in a monetary macro company CIO, Joseph Wang. All right, Joe, can the Fed, though, if it's dovish, let's say it's dovish for whatever reason, can they really afford to give up jawboning? It feels like that's the most effective arrow in the quiver, because markets and investors, they take off pretty quickly when Jay Powell gives them the nod, and Jay Powell he doesn't want to look foolish, right? If inflation rebounds. So they're between a rock and a hard place trying to articulate this dovishness you're talking about.
Well, absolutely, Charles. So what I've noticed in the past 2 years is that when the Fed says, I'm going to hike higher for longer, the market hears, oh, he's going to cut rates really soon. Now, tomorrow, though, when the Fed probably is going to signal some type of pivot, as in the sense that we might be cutting a little bit next year just because inflation has come down, I think the market is going to take that and just run with it. And they already have, right? They're pricing in almost 5 interest rate cuts next week. It's going to make the Fed's job harder because that's a little bit too much loosening in financial conditions. But all in all, though, it makes sense for them to adjust.
I'm sorry. How many rates do you think at this particular moment would be reasonable for next year? How many rate cuts?
I think 3 would be reasonable. We have made serious progress on inflation, and the economy is slowing. So I think having 3 show up in the dot plot tomorrow makes sense. It'd be 1 more than it was in the September dot plot. So I think it would be interpreted as dovish compared to the last meeting. But the market, of course, prices that in and a lot more already.
Yeah. I got to ask you about something that I'm trying to understand. This whole reverse repo market has been on fire, but all of a sudden it's coming down hard. We've got the chart up there. It's been rapidly declining. What message should we take from that?
Yeah, I used to run the reverse repo facility. So what the reverse repo facility is, it's like a giant checking account at the Federal Reserve. And so a lot of investors have been putting money in that because they get higher returns there. The offering rate there is close to the federal funds rate. But now that interest rates are higher because of tremendous amounts of bill issuance, money is coming out of the reverse repo facility and going into the banking sector. So you've heard a lot over the past few months that M2 has been declining, money supply has been declining. A lot of it is because it's been in the reverse repo facility. Now that's going to reverse. So we can have a lot more money going to the banking sector. Liquidity will increase. M2 will increase. And I think a lot of people view that as risk positive. Maybe marginally so, but a surprising amount of investors trade off of that.
What about the banks themselves and their exposure to the so-called belly of the curve, this sort of sweet spot with these T-bills? It feels like they're still somewhat between a rock and a hard place. Does the Fed acknowledge that in some kind of way?
Well, they're expected to cut rates next year, right? So I think as next year, right, as rates decline, that's going to give banks a lot of some room to breathe, right? Because they're going to be paying less on their deposit rates, and so that's going to improve their interest rate margins. And as money comes out of the reverse repo facility, you can expect banks to have more liquidity, so that's going to make them feel more secure.
Joe, I got 30 seconds. I just got to squeeze this in because it seems like that you've kind of got the blueprint in your mind of what's going to happen, but it seems like you're a little uneasy with the market becoming too excited about all of this. Are you concerned that the stock market, even maybe the bond market, is getting ahead of itself?
So the bond market, definitely. But when I take a step back, I'm looking at tremendous amounts of deficit spending, 7% this year, forecasted to increase without bounds going forward. Deficit spending, you're buying goods and services by printing treasury securities. That is functionally money printing, and that's really bullish for the stock market from my perspective. Now, as long as the bond market stays under control, I would expect the stock market continue to do well. Now, eventually, though, I think the bond market's going to wake up and it's going to realize that this issuance, it just won't stop. And I think then we might have some more volatility.
Yeah,
but at the moment, it's not there yet.
I think you're right. We'll see. Joe, appreciate your expertise, particularly in a day like today. Thanks a lot, my man.
Thanks, Charles.
All right, folks, coming up, my takeaway.